The global economy stands at a critical juncture as we approach 2026, facing a convergence of threats that bears an unsettling resemblance to the conditions preceding the 2008 financial crisis. Except this time, the vulnerabilities run deeper, the debt levels are exponentially higher, and the tools available to policymakers are far more limited than they were nearly 2 decades ago. While mainstream financial institutions project moderate growth and maintain relatively optimistic outlooks, beneath the surface lies structural weaknesses that threaten to unravel the fragile stability achieved since the pandemic recovery. And understanding why 2026 could witness an economic collapse worse than 2008 requires examining the interconnected web of debt, asset bubbles, geopolitical tensions, and exhausted monetary policy that defines our current moment. The warning signs are already visible for those willing to look beyond quarterly earnings reports and official economic forecasts, from unprecedented sovereign debt levels to a commercial real estate crisis that dwarfs the subprime mortgage problems of 2007, from banking sector vulnerabilities exposed by recent stress tests to household debt reaching record highs, even as delinquencies climb steadily across multiple categories. What makes the potential 2026 crisis particularly dangerous is not any single factor in isolation, but rather the synchronized timing of multiple debt maturity walls, the exhaustion of central bank ammunition after years of emergency measures, and the compounding effects of geopolitical fragmentation that has fractured the global economic system into competing blocks with diminishing capacity for coordinated crisis response. To understand how we arrived at this precarious position, we need to trace the accumulation of systemic risks that began not with the pandemic, but with the response to 2008 itself, when central banks worldwide chose to address a debt crisis by making credit cheaper and more abundant, effectively solving a problem of excessive leverage by encouraging even more borrowing across every sector of the economy, from governments to corporations to households. The Federal Reserve, European Central Bank, and other major central banks slashed interest rates to historic lows and engaged in massive quantitative easing programs that injected trillions of dollars into financial markets, policies that successfully prevented a complete economic collapse but also created the conditions for an even larger crisis by inflating asset prices far beyond their fundamental values and encouraging risk-taking behavior that would have seemed reckless in any previous era. This cheap money environment persisted for over a decade, interrupted only briefly before the pandemic triggered another round of even more aggressive monetary stimulus, and the result has been an explosion of debt across every category that now totals over $109 trillion in developing nations alone, while developed economies carry debt to GDP ratios that exceed levels previously seen only during major wars. The commercial real estate sector provides perhaps the clearest preview of the crisis to come, with $957 billion in loans maturing in 2025, representing nearly triple the 20-year average, while an additional $1.8 trillion in commercial loans are scheduled to mature in 2026, creating a refinancing wall that property owners and lenders are profoundly unprepared to scale. What makes this situation particularly treacherous is that these loans were originated in an era of near-zero interest rates and were based on property valuations that reflected those exceptionally favorable financing conditions. But now these same properties must be refinanced in an environment where interest rates have risen from near zero to over 5%, while property values have declined by 20 to 30% across various sectors. Office properties face the most severe challenges, with valuation declines of 30 to 40% and vacancy rates exceeding 25% in many markets. A structural crisis driven not by temporary economic weakness, but by the fundamental shift to remote and hybrid work that has permanently reduced demand for traditional office space. When property owners attempt to refinance maturing loans, they confront a brutal mathematical reality where their buildings are worth less than the outstanding debt, while simultaneously facing much higher interest costs on any new financing they can obtain, a combination that forces them to either inject substantial new equity capital, accept severely diluted ownership positions, or walk away from properties entirely and hand the keys back to lenders. The banking sector's exposure to this commercial real estate crisis cannot be overstated, with 278 banks identified as particularly vulnerable to commercial property losses and commercial mortgage-backed security delinquency rates reaching 7.29%. Nearly 6 times higher than traditional bank loans and representing the highest stress levels in securitized commercial real estate debt since the 2008 crisis. These delinquencies will translate into actual losses as properties are foreclosed and sold at prices well below the outstanding loan balances. Losses that will erode bank capital and force institutions to restrict lending precisely when the broader economy needs credit to remain available. The European Central Bank has warned that global uncertainties have surged to exceptional levels, creating an environment of heightened fragility where risks once considered remote are becoming more likely, with threats emanating from geopolitical tensions, shifting trade policies, climate crises, demographic change, and technological disruptions. What the ECB is diplomatically acknowledging is that the financial system has become extraordinarily vulnerable to shocks, with banks inadequately prepared for the compounding effects of multiple simultaneous stresses, hitting different parts of their balance sheets at the same time. The 2025 stress tests of European banks, while officially confirming increasing resilience since 2014, actually reveal significant vulnerabilities when examined closely, particularly regarding banks' exposure to sovereign debt, whose sustainability is increasingly questioned given weaker than expected growth, higher defense spending requirements, and structural challenges from aging populations and climate change. Sovereign debt has reached unprecedented levels, with almost 40% of external public debt repayments from lower-income countries going to commercial lenders between 2020 and 2025, while total debt in developing nations surged to $109 trillion by mid-2025, figures that represent not just large numbers but fundamental questions about the capacity of governments to service these obligations without triggering either default cascades or brutal austerity that devastates economic growth. The G20's failure to deliver meaningful solutions to sovereign debt distress, offering only vague promises to enhance the often criticized common framework and calls for increased debt transparency, reveals the profound lack of political will or institutional capacity to address these vulnerabilities before they metasize into full-blown crises. In the United States, household debt has reached a record $18.59 trillion in the third quarter of 2025, an increase of $228 billion from the previous quarter, with mortgage balances totaling $13.07 trillion and growing by $137 billion in just 3 months. These aggregate numbers mask a deepening divide where millions of Americans are falling behind on credit cards and loans even as others maintain strong financial positions, creating what economists call a K-shaped recovery where the experiences of different income groups diverge radically. Consumer debt delinquencies are rising across multiple categories simultaneously, pushing millions to the financial edge and threatening economic stability as defaults on credit cards, auto loans, and personal loans climb to levels not seen since the immediate aftermath of the 2008 crisis. The average American now carries $104,755 in total debt, with credit card balances increasing, auto loan debt rising, and home equity lines of credit growing by 9% as homeowners increasingly borrow against their properties, potentially to service other debts. A pattern that recalls the dangerous home equity extraction that amplified the 2008 crash. What makes the current household debt situation particularly concerning is that unlike 2008, when the problem was concentrated primarily in mortgages, today's vulnerabilities span every category of consumer borrowing simultaneously, meaning that deterioration in employment conditions would trigger defaults across the entire spectrum of household credit rather than being contained to a single sector. Corporate debt presents yet another dimension of systemic risk, with the Federal Reserve's proposed 2026 stress test scenarios, incorporating a sharp 4.4 percentage point increase in the BBB corporate spread from starting values, the second most severe observed increase, reflecting heightened default risk across the corporate sector. This corporate debt vulnerability is not merely a theoretical concern, but a practical reality as global bankruptcies continue rising, with projections showing a 6% increase in 2025 and an additional 3% rise in 2026, following a 10% jump in 2024, representing a sustained wave of corporate failures that far exceeds normal business cycle patterns. The Allianz Trade Analysis makes clear that relatively high interest rates are putting pressure on highly indebted sectors and companies facing specific financing challenges, such as green transition costs, competition from artificial intelligence, or supply chain disruptions, while their estimates suggest that a 1% fall in credit availability would lead to a 3% increase in U.S. insolvencies over the following 3 months, revealing the extreme sensitivity of corporate survival to credit conditions. The challenge for central banks navigating this environment is that they face conflicting imperatives that may prove impossible to reconcile, needing to maintain interest rates high enough to control inflation, but low enough to prevent triggering cascading defaults across commercial real estate, corporate debt, and household borrowing. The Federal Reserve has begun cutting rates, but is expected to pause when the target rate reaches 3 to 3.25%, a level that, while lower than current rates, remains far above the near-zero conditions under which much of the existing debt was originated, meaning that even with rate cuts, the refinancing environment will be challenging for borrowers accustomed to exceptionally cheap credit. The European Central Bank faces an even more constrained situation with slow growth, slack in the economy, and inflation below target. Yet the tools available to stimulate growth are limited, given that interest rates are already relatively low by historical standards, and further cuts risk destabilizing currency markets or encouraging capital flight. What central banks lack in 2026 that they possessed in 2008 is the element of surprise and the credibility that comes from unused ammunition, as markets now understand that emergency measures like quantitative easing and near-zero rates are the standard response to crisis rather than exceptional interventions, reducing their effectiveness and raising questions about what tools remain available if those measures prove insufficient. The geopolitical dimension of the approaching crisis compounds these economic vulnerabilities by fragmenting the global system into competing blocks with reduced capacity for the kind of coordinated policy response that helped contain the 2008 crisis. Trade tensions and tariff escalation have largely plateaued but continue to disrupt supply chains and fragment trade and capital flows, creating a smaller supply of foreign goods and rising prices that weigh on US growth, while reduced American demand for imports leads to overcapacity across much of the rest of the world. This simultaneous supply shock hitting the United States and demand shock affecting export-dependent economies creates a scenario where different regions face opposite problems requiring contradictory policy responses, making coordinated global action far more difficult than in 2008 when all major economies face similar challenges simultaneously. China's growth is moderating under pressure from US tariffs and subdued domestic demand, with anti-involution policies attempting to address excessive competition and deflation, but overall economic momentum slowing to levels that may prove insufficient to support global growth, as China has done in previous downturns. The forecast that global GDP growth will decline after a period of steady but underwhelming performance amid policy shifts and new uncertainties captures the sense that the world economy is running out of momentum precisely when it needs to accelerate to outgrow its debt burdens. Some economists warn that the US could face a potential recession in 2026 if hiring momentum continues to weaken and unemployment rises faster than anticipated, a scenario that would quickly spiral given the elevated levels of household and corporate debt that leave little margin for error. The tail risks identified by major financial institutions include downside scenarios, where labor market weakness spills over to consumer spending and foreshadows recession, with stagflationary dynamics amplified by tariff aftershocks, creating the toxic combination of rising unemployment and persistent inflation that makes effective policy response nearly impossible. The timing of these converging vulnerabilities is not coincidental, but rather reflects the synchronized nature of debt cycles, as loans originated in the ultra-low rate environment of 2014 to 2021 now reach maturity simultaneously across commercial real estate, corporate bonds, and sovereign debt, creating refinancing pressure across the entire system at once rather than spread out over time. The peak of loan maturities occurring over the next 24 months creates a narrow window where the success or failure of refinancing efforts will determine whether individual debt problems remain isolated or cascade into systemic crisis. The insurance protection gap, with only around 25% of natural hazard losses insured, poses additional risks to economic growth and bank balance sheets as climate-related disasters increase in frequency and severity, potentially triggering unexpected losses that force banks to reserve capital they had planned to use for lending. The integration of contagion risk analysis into the 2025 EU-wide stress test reveals how solvency-driven liquidity shocks can trigger market reactions that propagate through the financial system and amplify losses stemming from initial exogenous shocks, creating the kind of cascading failures that transform localized problems into systemic crises. Investment funds, particularly equity funds, face the greatest losses under adverse scenarios, while banks with less sophisticated hedging capabilities are significantly affected, highlighting how interconnectedness across different financial sectors creates pathways for contagion that pure balance sheet analysis would miss. The loss mutualization mechanisms of central counterparties can transmit risks under stress scenarios to clearing members, meaning that failures in one part of the derivatives market could rapidly spread to banks and other financial institutions through their roles as clearing members and their obligations to finance default funds. What emerges from this comprehensive examination of vulnerabilities is a financial system that resembles a highly complex machine running at maximum stress with multiple components simultaneously approaching failure points, where the breakdown of any single element could trigger cascading failures across the interconnected whole. The comparison to 2008 is both apt and insufficient, as the current situation shares the fundamental characteristic of excessive leverage built up over years of cheap credit and inadequate risk assessment, but differs in crucial ways that may make the coming crisis even more severe. In 2008, the problem was primarily concentrated in US residential mortgages and the complex securities derived from them, allowing policymakers to focus their response on recapitalizing banks, supporting the housing market, and preventing foreclosure cascades. In 2026, by contrast, the vulnerabilities span residential and commercial real estate, corporate debt, sovereign debt, and household borrowing across multiple categories simultaneously, while geographic dispersion across the United States, Europe, China, and emerging markets makes coordinated response far more challenging. The exhaustion of monetary policy tools means that central banks cannot simply slash rates to zero and flood markets with liquidity as they did in 2008, because rates are already low by historical standards and further quantitative easing risks undermining currency credibility or triggering inflation that forces rates back up. Fiscal policy faces severe constraints given the unprecedented levels of government debt accumulated through pandemic response and years of deficit spending, leaving limited capacity for the kind of massive stimulus programs that helped support recovery after 2008, without triggering concerns about sovereign debt sustainability. The political environment has fragmented since 2008. With rising nationalism, trade tensions, and geopolitical competition replacing the cooperative spirit that enabled coordinated global response through forums like the G20, making it unlikely that major economies could rapidly agree on and implement synchronized stimulus and financial stabilization measures. Financial markets have become increasingly concentrated in a small number of extremely large institutions whose failure would have systemic implications while simultaneously growing more complex through derivatives, algorithmic trading, and interconnected global capital flows that can transmit shocks across borders and asset classes with unprecedented speed. The lesson of financial history is that crises typically arrive through channels that regulators and market participants have overlooked while focusing on the problems of the previous crisis, and the current fixation on avoiding a repeat of 2008's housing market collapse may be blinding observers to the commercial real estate, corporate debt, and sovereign debt time bombs ticking toward 2026. The convergence of these multiple debt maturity walls in 2026, combined with exhausted policy tools, elevated geopolitical tensions, and a fragmented global economic system, creates conditions for a crisis that could indeed prove worse than 2008, not in the sense of being a mere repeat, but rather as a more complex, multi-dimensional breakdown that proves harder to contain and resolve. Whether this potential crisis actually materializes depends on factors that remain uncertain, from the trajectory of inflation and employment to the decisions of central banks, to the emergence of unexpected shocks that could trigger the cascade of failures that all the structural vulnerabilities have made possible. But the warning signs are unmistakable for those willing to see beyond the reassuring official forecasts to the deeper fragilities beneath. The question is not whether the global economy faces serious risks in 2026, but rather whether policymakers, financial institutions, and market participants will act with sufficient urgency to address these vulnerabilities before they metastasize into crisis, or whether the combination of complacency, conflicting interests, and institutional constraints will allow the system to slide toward a breakdown that future historians will judge was both predictable and preventable. Recent analyses confirm that the risk of a systemic global economic crisis in 2026 is not only high but also fundamentally shaped by deeper, more structural factors than previous downturns. Independent financial experts estimate the probability of a severe recession or critical instability in the world economy over the next 12 to 18 months in the range of 30% to 60%. A pessimistic range exceeding the estimates seen before the 2008 collapse. Most concerning is that this time the core triggers combine unresolved debt burdens with financing stress synchronized across key economies. As global sovereign and corporate debt reaches historical extremes, central banks are forced to juggle stubborn inflation with the urgent need to support momentum, all while their usual stimulus options are increasingly constrained by political divisions and inflation anxiety. For the US, forecasts show real GDP growth slowing around 1.6% in 2025 as investment pulls back and labour markets soften, while Europe is held back by energy and demographic headwinds. And China contends with a deepening real estate downturn and weaker domestic demand. In parallel, the threat of liquidity crises grows not just for banks, but also for investment funds, insurers, and pension structures, exposing fault lines well beyond the traditional financial sector. Analysts highlight that should central banks pursue further rate hikes in 2026, or even maintain current restrictive conditions, the resulting tightening could trigger a new recession or accelerate cascading defaults, especially as companies and households exhaust their ability to refinance on affordable terms. As business investment falls, corporate bankruptcies rise and risk spreads widen. Emerging markets face rapid capital outflows and devaluation pressures. Meanwhile, trade wars, sanctions, and long-running military conflicts strain already fragile supply chains, amplifying energy and food price shocks, deepening uncertainty, and eroding the investment climate. In this environment, major global financial institutions signal that the red zone for warning indicators has been reached. High-yield bond defaults could spike to 4.5%. While corrections in financial markets of 15 to 20% are possible as volatility surges, amplifying stress throughout the global balance sheet. Some pessimistic analysts even suggest that, historically, when crises of global overproduction and financial misalignment develop, they can catalyze major geopolitical upheaval, a scenario raised as plausible under today's strained international relations. Most forecasts suggest that even absent an acute black swan event, the volatility and fragility of 2026 risk delivering a multi-layered downturn, much broader and potentially more destabilizing than anything seen since 2008, precisely because it originates not from a single sector or region, but from synchronized stresses and decades of institutional neglect across much of the developed and developing world.